In this part 2 of share buybacks, we'll just quickly look at the different types of share buybacks in South Africa and then the effects that it has on certain ratios in the company. So you don't have to worry too much about this section, and you'll probably not get a question in the exam this year on this, but it's important knowledge for later on. So in South Africa, the Companies Act only started allowing share buybacks since I think it's July 1999. But in the US and internationally, it's been going on for more than 50 years. So there's basically two types of repurchases or buybacks in South Africa. The first one is a general buyback, and that's where the company basically just buys back its shares like anyone else buys shares in the company. So through a trading account or a broker, they just buy shares in the open market at the market price. Now, they don't have to announce these buybacks until they reach a certain threshold. So if in total for a specific year they bought back more than 3 or 5%, I can't remember the exact percentage now. I think it's 5%. They have to announce the general repurchase. So it's the shareholders or the market won't really even know about these buybacks until they've reached the threshold. And the second type of buyback is specific buybacks or specific repurchases. And there's two types of these specific repurchases, but for that they need a special resolution passed at the general meeting. And the first one is a pro rata offer to all the shareholders. So they offer so if they want to buy back R1 billion worth of shares, they have to offer it pro rata to all the shareholders or pro rata to their shareholding. And then shareholders could opt to take part in the buyback or not. And the other type of specific repurchase is for a specific offer to a specific shareholder, in both these cases with specific repurchases, they have to announce it immediately as part of the listing requirements of the JSE. Okay, so the effects of a share buyback. Return on equity is levered up because obviously equity is reduced. Remember, equity is at book value in the book, so it's profit after tax divided by the equity at book value. But the book value is reduced by the market value of the repurchase. So the return on equity will be quite a bit higher if it's a big repurchase. Then the net asset value per share. Well, the net asset value in total decreases as a result of the cash that leaves the company, but the number of shares is also reduced. So if the share price per share is higher than the net asset value per share, the net asset value per share would decrease post the buyback. And if the share price equals the net asset value per share, then the pre and post net asset value per share would be the same. And earnings per share, we said earlier, one of the reasons why companies buy back shares, that was in part one, is to increase earnings per share, which implied value creation, which it's not. Well, the earnings will decrease slightly because of, remember, the cash leaves the company because they paid out, it's like a dividend, but they bought back the shares with the cash, so they lose out on the interest income on that cash, but the number of shares also decreases. So usually the earnings per share increases after the buyback. And then lastly, does shareholder value increase because earnings per share increases? Not necessarily, because the PE ratio, the price earnings ratio, won't necessarily stay constant. So the effect on the value depends on whether the repurchase was at the price higher or lower than the intrinsic value of the share. But remember, if it's bought at a price lower than the intrinsic value, so it was undervalued, the share price, then you just shift the value from the shareholders that participate in the buyback, in other words, the shareholders that's selling the shares to the company, to the shareholders that stay invested in the company.